Good afternoon, MVMA members. Thank you for joining Managing Your Money Buckets with Mr. Garrett Palau. I'm today's moderator, Nicole Cast, and the CE Program Manager for the MVMA. I know many of you have joined us before, but for those who haven't, please, if you have any questions, type them in the Q&A area. For those of you who aren't familiar with where the Q&A area can be found, at the bottom of your WebEx screen, you'll see a series of circles. Look for the black circle with the 3 dots and click on that, and the Q&A option will pop up. I would like to introduce today's presenter, Mr. Garrett Palau, an independent financial consultant with North Star Resource Group. Garrett has drawn to the career of financial advisor due not only to a desire to work in finance, but also to help others view their finances as a source of comfort rather than worry. As an advisor, he values mutual trust and transparency in his client relationships. Garrett's clients have strong family values and want to provide the best lives possible for their family members. To help them achieve this, his strategy involves educating his clients on being efficient and effective with their finances while developing a comprehensive strategy based on their current financial situation and future goals. Garrett works with professionals across a variety of industries, including physicians, veterinarians, and lawyers in both Minnesota and Florida. Please go ahead, Garrett.
Thank you, Nicole. I appreciate that. And thanks for that introduction. I didn't realize it'd be so thorough. I hope everybody is staying safe and healthy with everything that has been going on. It's a crazy and trying time that we're in as a country and as a society. And first and foremost, hope everybody is staying safe. I'm really excited to be here with you guys on this WebEx and to go through kind of our topic today. And I hope at the very least you find some value from this conversation. If not, hopefully be able to take some things and utilize them either on your own or with whatever your financial life and plan is doing at this moment. So this won't nearly take up the hour. Hopefully we'll get a good chunk and some good information. We're going to try to keep this high level because everybody's situation is different, and we're just trying to get a good baseline. And then whatever questions you get, anybody has throughout the presentation, please ask them, as Nicole said, or we can also go ahead and take care of those at the end. So I will go ahead and share my screen. Should be good to go there. So like Nicole said, we're going to be talking about managing your money buckets in today. So that really is just, hey, how do we make sure that we are being efficient and effective with our wealth accumulation and our wealth distribution, possibly once we're in retirement time, and why it's important to have a good diversity and a good strategy in regards to your financial plan. Oh, hang on, it's not going next. There you go. So today's agenda, we're going to be overview of the money buckets, what they are real quick. Then we'll dive into each one individually, how they work, things to consider. Why does this matter? Why do we want to be aware and efficient with our buckets over time? We'll go through an example, a very basic example, but just to show you the power of making sure that we are being efficient and why it is important. Some steps to take, and then any questions at the end in that point or during this time. So your money buckets, this is really broken up into 4 different buckets if we want to look at it with your financial life. The first one is your short-term bucket, so anything that's in the short term, obviously. A medium term, so anything not quite retirement, but maybe a 4 to a 15-year time horizon. A supplemental retirement, so things to do above and beyond what maybe the practice or your employer-sponsored plan or other retirement accounts. Maybe an early retirement, you want to back off part-time and a little bit of a supplemental retirement account or income at that point. And then your long-term or your retirement bucket, which is the one that most people are most accustomed to, and it's utilized the most, and it's very important. So to kind of lay these out in a picture format, here's kind of the buckets. We have our bucket 1, which is the short term, bucket 2, that medium term, 3 is that supplemental retirement, and 4 is that long-term or retirement plan. In all these buckets, we want to take into consideration a few things, not only the taxation, but what is the liquidity? So liquidity just means what is the ease of access? Are there any penalties to getting to these dollars? How fast can we get them? Depending on the time horizon, the goal and objective of the specific account, we want to make sure we're taking into account what liquidity and ease of access to the account at that time. Taxes. Well, how is the account taxed and when is it taxed? How can we minimize taxes, not only during our wealth accumulation, but also be tax efficient with our wealth distribution at some time in the future when we're starting to rely on our portfolio that we've built up over our career to provide our income now that we're not working. And then asset protection. So if they are they protected in the case of creditors and litigators, God forbid, if something were to happen legally, maybe with the practice, or if you're a solo practitioner and not everything is established maybe the way we want it to be, how do we make sure that these are asset protected for you? And also to consider are what we call our eroding factors of wealth. So this sounds a little dark and gloom, but we want to be aware of how our wealth is eroded over time based on these different factors. The first one and the biggest one, everybody's aware of it, is the taxes. So when is it taxed, how is it taxed, and at what rate do we experience that tax? So if we think just for an example, our income tax, we have here in Minnesota, we have high state income tax, and then we're paying federal income tax. And this is, if we make $100,000, we're taking home $70,000 kind of deal. So that's an eroding factor of wealth. The second one is inflation, or the cost of living, the cost of goods increasing over time. $1 30 years ago is worth about the same as $2.50 today. Things go up in price over time. Now, a little opposite of how gas is acting recently. Nobody's driving, so gas prices are plummeting. But in general, over the next 10, 15, 30, 20 years and beyond, the cost of living is going to go up. Milk is going to cost more. Just general goods are going to be more costly. And then the opportunity cost of our wealth. What is the cost to doing or not doing a specific action or decision? Do we pay down debt? Do we pay down or contribute and invest and save? Or do we not do either one of those, and now it's kind of just sitting in limbo? There's a cost, an opportunity cost to everything we do. We want to make sure that we're aware of that and prepared for that if that may be the case. So diving into the different buckets, we'll start with your short-term bucket. So this is on a short-term time horizon. Granted, easy names, right? So generally a now to 3-year time horizon. So anything we're really planning in that short amount of time. So that includes our emergency reserve, which quantitatively, or if you're reading by the book, should be about 3 to 6 months of your fixed expenses. Everybody's going to have a little bit different emotional attachment to their emergency reserve and their savings. But for a general rule of thumb, we want to be in that 3 to 6 month range. And then any short-term goals that you may have within a 3-year time frame. So that might be buying a house, buying a cabin, a practice buy-in or buy-out. Whatever the case is, anything in a short-term time horizon, we want to make sure that that's staying in this kind of short-term bucket. The reason being, we don't want, if we're going to planning on buying something in 2 or 3 years from now, we don't want to expose those dollars to any market volatility or investments, because then that would be a risky play. And risks to me, and how I explain to my clients, is what is the chances that your dollars that you put in are worth less when you go to access them. And in a 2 to 3 year time frame, the chances of that happening aren't, I don't want to say high, but it's very possible that it could be. If we look at this year so far, it's been a pretty down year. 2019 was a really up year, and 2018 was a down year as well. So we never know in the short run what volatility will be. So we want to make sure that these funds, when in a less than 3 year time frame, are defensively postured, so that way they're available when you go to access them. The most common types of accounts that you'll see are bank accounts, so your checking and savings. There's a whole bunch of different other accounts under these, but most people will have these. And as a general rule of thumb, so you'll see those months there, in our checking account, we want to have 1 to 2 months worth of our expenses. So that's more the revolving door, if you will. And then in our savings, we'll have that 3 to anything above that 1 to 2, so that 3 to 6 in savings, maybe earning a little bit of interest, like a percent and a half, nothing spectacular, but we're keeping it. It's one of our bases of our financial foundation, and we're able to keep it in the short term. Dollars that go into these types of accounts are after-tax dollars. So if we think about your paycheck, taxes are generally withheld depending on how you're paid. Obviously, if you're relief and you're getting 1099 income or something like that, a little bit different situation. But overall, these are funded with after-tax dollars, or we're hanging on to dollars after they've been taxed. Any interest that you accrue in these accounts, so think of a savings account, that interest is treated as earned income in the year that it's earned. So if you have a savings account and it is giving you 1% interest, and you earned $1,000 of interest in 2020, you're gonna be taxed on that $1,000 as earned income, or in your tax bracket that you're gonna experience in 2020. These are extremely liquid, so we can access them pretty much immediately. We have ATMs, bank cards, credit cards through the bank, stuff like that. We can get to these dollars immediately. So what we're gaining in liquidity and that access and that ease, we're kind of giving up with some of our either our taxes or ability to earn a higher rate of return over the long run. And there's no funding restrictions. It doesn't matter how much money you make or how much money you put in a checking account. You're not restricted to the amount that you can accrue in these accounts. Now, granted, we don't want to have too much and be inefficient with our accounts, but everybody's in a different situation and everybody's going to have a different amount that they're putting in. But overall, there's no restrictions to what we can put in. And there's no asset protection when it comes to these types of accounts. So if you were in some sort of legal situation, they would be able to come after any dollars that would be held in these kinds of accounts. Your medium-term bucket. So generally, this is a 4 to 15-year time horizon. It can be more than 15 years, depends on the goal and what you were trying to accomplish. But generally, it's in that range. And it doesn't really need to have a specific goal in mind. It's just anything that we're not planning for long-term or retirement, and not anything that we're not planning on doing in the short run. So we have a bucket that we want to make sure we're continuingly to be efficient with our dollars. The most common type of account is what's called a brokerage account or non-qualified investment account. So non-qualified just means that it doesn't qualify for any special tax treatments. But this is usually the account that when I'm working with clients that we're utilizing for our medium-term bucket. We fund these accounts with after-tax dollars. So similar to our bank accounts in the short-term bucket, we're funding these with the same types of dollars. And really, this medium-term bucket, you want to look at it like a checking or savings, but we have investment options. So it's doing kind of the same thing. It works kind of the same way, but we're able to actually invest the dollars in the market and appropriately depending on your specific goal for the account. As these dollars grow in the account, they are taxed at what's called the capital gains tax rate. And this all depends on your income and where you're at from a income bracket perspective, but it's not the same as your earned income as it is in the short-term bucket. So capital gains will generally be in the around 15% range, then depending on your income and household, up to maybe 20%. But we're taxed on the capital gains on an annual basis on any earned income or on any earned growth in the account. So at the same time, if we experience a loss in these accounts, we can take what's called a capital loss, and then we can actually write that off on taxes, and we can do things called tax loss harvesting and make sure we're managing that appropriately, which is a much more detailed conversation, but there's a lot of flexibility there. There is high liquidity in this account, whereas our short term, I kind of classified it extreme. This is high liquidity, so we can access it really quickly. Now, generally, if you have one of these accounts, it's not held at your bank. Banks do have, and depending on your bank and the size of it, do have these kind of accounts. But generally speaking, if you're having it professionally managed or utilizing somebody like me, where it's invested at an investment company or investment firm. So that would take, it takes a couple days to process it and get it transferred back into your bank account, but we can access it really quickly, and there's no transaction fees or costs to access the funds. So what we get in liquidity, and there's no funding restrictions either, or we can put as much money as we want. So as what we get in this flexibility, we're giving up in as far as our tax efficiency, and we have to worry about the capital gains tax on an ongoing basis. And also, these aren't asset protected, so it's these last two fall in line with kind of how that short-term bucket is. So if you are dealing with some legal issues and something happens and they're suing you, they can come after their dollars in these accounts. So that's why once these get to a certain amount from a dollar perspective, we want to make sure that they're titled appropriately to minimize your liability and the bill, and we could do some things to make sure we get these as protected as possible. So your long-term or retirement bucket. So this is really on an age 60 plus time horizon. So the reason why there's some restrictions and rules around the age 60 time mark. So we want to make sure that this is anything that we're for retirement or beyond age 60. The most common types of accounts are what are called qualified retirement accounts. So these are specifically designed for long-term and retirement. And there's really two different types of qualified retirement accounts. There's what's called the traditional qualified retirement accounts, which include 401ks, simple IRAs, SEP IRAs, or even a traditional IRA or rollover IRA if you have that. And then the other type is a Roth. So there can be a Roth 401k depending on how the practice might have it set up, or a Roth IRA, which is most commonly known out there. So there's two different types of retirement accounts from an overarching perspective, the traditional and Roth. And they work a lot alike, but there are some really big drastic differences in the way that they are taxed. So the traditional qualified plans, these are funded with pre-tax dollars. And this will be something that a lot of people are familiar with as we go through this, but they're funded with pre-tax dollars. So you get a tax deduction today. So if you make $100,000 and you put $10,000 into this traditional qualified plan, you're going to be essentially taxed as if you earned $90,000 in that tax year. So we're taking a tax deduction today. The funds that are invested in the account, they grow tax deferred. So tax deferred means that there are no taxes owed as the account grows. If you put $10,000 into account today, and 10 years from now it was worth $20,000, you don't have to pay taxes on that additional $10,000 of growth, which is really nice. But once we do get to retirement and we take distributions from this account, all distributions are fully taxable as earned income. So if you withdrew $50,000 from this account, you would be taxed in that year as if you earned $50,000, similar to how you're earning an income today. So just as a recap, we put dollars in, we get a tax deduction. That we don't pay taxes as the account grows, but then once we pull the dollars out in retirement time or when the time comes, we have to pay taxes at that point. These have low liquidity. So as the other ones were extreme and high, these are low. And that's because generally there are early withdrawal penalties if you try to access them pre-age 59 and a half. And that's a 10% early withdrawal. Now, there are a couple exceptions to the rule, but usually they're sometimes kind of hard to do, and if we're or we don't qualify, whatever the case is. So most people will run into an early withdrawal penalty. So not only do we have to pay taxes on any of the distributions, but if we do it pre-59 and a half, we have to tack on an additional 10% penalty. So you can see how that gets eaten away really quickly. There are also what's called required minimum distributions. So at the end of last year, there was a new legislation passed that changed the required minimum distribution age from age 70 and a half to age 72. And there's a little bit of overlap if you're in that age 70, 71 range. That would be specific, but for the most part, moving forward, everybody will be required to take a distribution from their traditional qualified plans once they reach age 72 and every year after that. So essentially what's happening here is the IRS is saying, hey, these dollars have never been taxed. You took a tax deduction when you put the dollars in when you were working. You've never paid taxes as they've grown because they were tax deferred. And now we want our money. We want our taxes. So they're requiring you to take a distribution every year once you turn age 72. And there's a special formula. It's not hard to do, but it's basically your mortality, your life expectancy, and then they base it off of the previous year-end account balances for all your traditional plans. There are funding limitations. Depends on what kind of account you have access to. If you have a 401k, it's $19,500. A simple IRA is $13,500. A regular traditional IRA is $6,000. A SEP is generally around 20% of your gross income. There's a special formula that the accountant will tell you with a maximum of $55,000. So there are some funding limitations, and depending on the kind of account, not employer-sponsored plans, there may be some income limitations as well. The benefit to these kind of plans as well are that they're 100% asset protected, which we like. So if something happens, they can't come after your retirement, your qualified plan account. For the Roth plans, like I mentioned, there's a lot of overlap in how they work, but there are two main differences on how they differ from the traditional plans. So we fund them with after-tax dollars. So we're paying the taxes today, and it's taxes earned income because we're utilizing funds after we've earned them. So we're putting dollars in, we'll fund it from your checking account or whatever the case is. We've paid taxes today. Just like the traditional plans, the funds invested in these accounts grow tax deferred. So as it grows in value, we're not paying taxes on an annual basis on any of the growth. However, since we've funded these accounts with after-tax dollars, the distributions from these accounts in retirement time or whenever we pull them out are not taxable. So it's a tax-free distribution to you. So in essence, because we've already paid our taxes on the front end, we don't have to pay the taxes on the back end. Just like the traditional plans, there's low liquidity. There are a couple exceptions to the rule, but generally there's an early withdrawal penalty if we try to access these kind of accounts pre-59.5. And if you access any of your gains in a Roth plan pre-59.5, there's actually you will owe taxes on that as well. So it's really not beneficial to be accessing these dollars pre-retirement, essentially. Unlike the traditional plans, there are no required minimum distributions for Roth plans, and that's because you've already paid your taxes. So the IRS isn't coming hounding. You're not going to get double taxed on this, which is a good thing. Just like the traditional plans, there are some funding limitations. The 401k is the same. It's $19,500. But the most common is the Roth IRA, and this is a $6,000 annual limit for 2019 to 2020. And also, if you are above age 50, you can do a catch-up contribution, and you can put up to $7,500 in. So what this allows you to do is you are limited in what you can put in, and there are some income limitations as well. So if your household income is above a certain amount, you can't directly contribute to a Roth IRA. And just like the traditional plans, these are 100% asset protected. So if something were to be happening legally, they can't come after these accounts, which is fantastic. Our last bucket is our supplemental retirement bucket. So generally, this is when we're talking about a 15-year time horizon, and this doesn't necessarily have to be supplemental retirement, but anything above and beyond that 15 years. And generally where we use this though, and why we call it a supplemental retirement, is if somebody's trying to say, I don't want to work as much in my 50s, so I'm making less, so we have to supplement some income before we're age 59 and a half. Or we want to utilize these accounts for something we want to buy in our 50s and we want to plan now, and we have 15 plus years to plan for it. The most common type of account is what's called investment grade cash value life insurance. So there are, when we talk about life insurance, we're not going to dive into life insurance today or anything, but there are two different types. There's what's called term life insurance and there's permanent life insurance. And investment grade cash value life insurance is under that permanent life insurance umbrella. There's a lot of different types of permanent life insurance. A lot of people might have heard of a whole life or universal life or something like that. And we would just, when we're utilizing these types of buckets and these types of accounts, we just want to make sure that it's investment grade, meaning that it's going to work really similar to all of our other investments in our portfolio. We fund these accounts with after-tax dollars, so very similar to the Roth IRA. We've already paid our taxes when we put these in. And just like the Roth IRA and the traditional accounts, any of the dollars that are invested in this type of account grow tax deferred. So no, there's no taxes owed as we accumulate wealth in this account. Now, when we take distributions out of this as supplemental retirement income, retirement income or something else, the distributions are not taxable. So kind of just like the Roth IRA. Now, there's a certain caveat because this is life insurance. You have to make sure that the distributions are taken correctly, which isn't hard to do, but if you do it wrong, then there could be taxes owed and all that kind of stuff. So you want to make sure it's done correctly. And there are some liquidity concerns. So we can access this pre-59 and a half with no penalty, like I mentioned, but this is not a short-term investment. We have to really follow that 15-year time horizon because these take a little bit of time to get going. There's some cost up front from an insurance perspective. And we want to make sure that we're giving this its due time to do exactly what it's supposed to do. So it's not a short-term investment, but once we get to that 15-year plus time frame, then we can access the dollars pretty easily and we don't have to worry about any penalties or transaction costs. There are high funding limits and there's no income limitations to these. So the funding limits are based off of the life insurance actually. So there is a mortality cost or a cost of insurance involved with this. So this is something that is not right for everybody. It's kind of a niche thing. You have to, have the right health and age. You gotta have to give it enough time to get going. We have to have the cash flow to do it, and it fits in your financial plan. But if we're able to utilize it, it gives us just another bucket that we can be really tax efficient with as we accumulate wealth. Just like our long-term buckets, these are 100% asset protected. So it's just another bucket that we have that is protected in case something, God forbid, happens. So why does this all matter? So at different points in life, we're going to have different reasons to access our money, our portfolio, what we've saved up. And that could be a down payment on a house or a cabin, practice buy-in. Maybe we're not working, so we need retirement income, education planning for kids or grandkids. Kind of the list goes on and on. But when we have something in our life that we need to prepare for, or we're ready to pull dollars out, we want to make sure that we're being as efficient as possible. And one bucket may be more efficient than the others. So if we go back to the short-term bucket, if we're planning, if it's a younger couple and they're planning on buying a house in the next 2 years, those dollars should be in our short-term bucket because that's going to be the most efficient way to make sure that we have those funds available. Versus if we want something on a long-term retirement and it's, for when we're in our 70s and 80s, this is something we want to put in those retirement accounts. That's going to be more efficient than utilizing a short-term bucket that's going to get eroded by taxes and inflation. So depending on the situation and our goal is going to determine what bucket we want to utilize. And then based on what's feasible, we want to make sure it's the most efficient vehicle for you and your plan. So to kind of go through an example, using some just easy numbers to hopefully show the impact, and this is more of a retirement example, but why it's important if we're in wealth accumulation to make sure that we're being efficient with that. So we have our first client, and all of our investments are in a traditional retirement account. So 401k or simple IRA, whatever the case is. And this is where most people will have the bulk of their investments because it's the easiest. We can put the most in through in an employer sponsored plan. And we're going to be able to allow this to grow over time. So most people are going to be this, and I come across it a lot where this is where majority 90% of our investments are put in. So we're retiring, and let's say we need $100,000 for year one of retirement, and that's to live our life. That's to pay for any debts like mortgages or living and vacation. We're in retirement. Let's enjoy it, kind of deal. So $100,000 is what we need to live life, and that's going to be different for everybody, obviously, but we're trying to use easy numbers here. So in order to get that $100,000, we need to withdraw around $125,000 from our traditional retirement accounts because those are taxed, and that's going to get us to net $100,000 so we can live our life. So this is assuming a 20% tax, which would be it's pretty rough, but that's probably around where that will be based off of federal and state income if we're talking about Minnesota and stuff. But let's say assuming a 20% tax, we're going to be paying 25% of taxes, and that's how we get to our $100,000. Now, client number two, they have a tax diversified portfolio. So they've been, doing stuff in the Roths and maybe Supplemental and their medium-term buckets, and they've been really diversified with their portfolio. So same need, we need $100,000 for year one of retirement. Now, instead of pulling all the money from our traditional retirement accounts, let's say we only pull $80,000 from that bucket. And then in that case, based on, we drop down a tax bracket so we could save in taxes, and assuming a 12.5% tax on that, should be pretty rough, but pretty close. We would pay about $10,000 in taxes at that point, and we'll net 70. So we're still about 30,000 short from what we need in year one. So in that case, we'll pull $30,000 from a tax-free bucket. So whether that's a Roth or a supplemental retirement, that investment grade cash value, but we'll pull $30,000 from there. And that's how we get to our $100,000. So kind of as a recap, client number one, we took $125,000 from our portfolio to net $100,000. So we paid $25,000 in taxes. Client number two, we only took $110,000 from our portfolio and only gave Uncle Sam $10,000. So we were able to save, our client number one will pay $15,000 more in taxes. Easy math, just being a little redundant, but we'll pay $15,000 more in taxes. If we say an average retirement, and a lot of my comprehensive planning clients and stuff, we're planning for about a 30-year frame for retirement. That's $450,000 in tax savings over that retirement plan. And that's not including any inflation or changes or anything like that. That's just $15,000 times 30. And what that does is not only is that a $450,000 tax savings, that's $450,000 that will be able to stay in your portfolio, continue to work for you, and continue to grow over time. So that's just why it's important to make sure that we are being diversified with all of our money buckets and continuing during our accumulation phase. And then once we're in our distribution phase, continuing to make sure that we're being efficient as we distribute those dollars. So what can I do? What's important is always understanding your strategies that you're doing from a savings and investment point of view, and how they're affecting your short-term, medium-term, and long-term financial planning goals. When it's possible, try to stay as tax diversified within your portfolio and within the account. So if you have a medium-term brokerage account, make sure that you're utilizing tax-aware investments, because those will reduce your amount of capital gains that you're going to pay, or try to reduce your amount of capital gains that you'll pay on an annual basis. And then keep up to date on the changes in the treatment of investment accounts from a tax perspective and a funding perspective, and as things change. this is reason why people like me have a job, but something that as the Congress and the government comes out with different rulings and the IRS, making sure that we're keeping up to date with things that have changed. So who we are, who I am. As Nicole said, I'm an independent financial consultant or financial planner, CFP, and certified student loan professional for the younger folks. That's a huge issue. A lot of my clients are recent, not a lot, but majority of the clients are recent vet grads, and they have high student loans, and it's something that's really bothersome, so good to have. Specialize in financial strategies for veterinary professionals, so that's comprehensive planning, protection management, investments, student loans, debt management, things of that nature. MVMA supporting sponsor, reason why I'm here with you today. Really appreciate it. Love the MVMA. Based in Minneapolis, but working with clients nationwide and statewide as well. So what to do next? Seek financial advice and develop a relationship if you haven't already. Where you can gather your information, start building your financial foundation. Make sure you're doing the first step correct as far as making sure we have proper emergency reserves and we're doing the right things from a debt management and risk management perspective. A little biased, find an advisor that you like, one, but also that specializes in working with veterinary professionals. They get what you're doing. They get what your life is like, how you work. They get your practice. If you're practice owners, they understand the veterinary world, understand how they're compensated. Are they strategy and planning focused, or are they more product and sales focused? Just kind of getting an idea. And at the end of the day, work with somebody that you like. Get organized, and of course, just get started. So if you haven't developed a relationship or you haven't had help, it's always good to reach out or have that person in your corner. A lot of times there's a little to no cost to at least start a relationship with somebody and understanding what's available for you, maybe some things that you can be doing better and moving forward. So kind of with that said, that's everything that I had, Nicole, and I can't really see if there was any questions because I'm sharing my screen, so that went away. But
right, yes, I understand. A reminder: if you have any questions, you can feel free to type them in the Q&A area, or if you'd prefer, I'm fine if you want to send me a private message and ask on your behalf. I know with financial situations, some people aren't always willing to share with a larger group. So I will give people just a moment. I don't currently have any questions, but let's just see if I have any. Just another minute here.
Yeah, it just means it did such a great job explaining. No,
exactly.
No, not at all. And I understand that financial advising and planning isn't everybody's forte. There's a reason why you have DVM behind your names for those on the call. And I don't know when metronidazole is the right thing to prescribe, but that's why I take my dogs to my vet. And there's a reason why it might be overwhelming or you think you have everything put together, but it's always just important to stay on this stuff because if you get behind, it really can be detrimental in the long run. So.
Yes, I agree with you. Whenever I attend a session like this, it reminds me to really actually look at those statements that always come a little more closely.
The first quarter statements for your investments, they don't look good.
Yeah, exactly. Yeah, I did kind of throw that one just in the pile the other day and went, okay, yeah, whatever. Let's see, you spoke about opportunity cost. This is a question coming from a new grad out of vet school with $270,000 of debt, with 50% of that being at 8.5%. Is it better to pay off the high interest loans or to invest for retirement? I think you get this question a lot.
It is. I would say that type of loan sounds like a private loan because there's, and it depends, there's different situations. Big question. When we talk about opportunity costs in specifics to either do we pay down debt or do we pay down or save? And when it gets as simple as that, we're looking at the interest rate. So at an 8.5%, if you think about it this way, $1 to debt or $1 to your investment is going to impact your net worth the same exact way. Either it's going to go up 1 because your assets grow, or you're going to subtract from your liabilities, so your net worth is still going to increase by 1. And when you put $1 to an 8.5 interest rate debt, you're getting at a guaranteed 8.5% rate of return. So, we really break down debt into good debt, kind of so-so debt, which is really more like your federal loans if you have an income-driven repayment plan, because they're still kind of high, but we can utilize those efficiently if we need to. And then you have your bad debt, which is really anything 7% or higher. And bad, not saying like you shouldn't have it or anything, but that's something that we want to attack. So in that situation, if you put $1 to an 8.5% debt, you're getting an 8.5% rate of return immediately and guaranteed on your money. So that, in my mind, would be a great investment. But it's a little bit of and that's a very specific answer to that specific question. There's a little bit bigger, broader picture as to making sure you're still being efficient with all of your loans, all of your options, and everything else that you might have. So, but yeah, overall, if we're opportunity cost, if we can pay down high interest debt, we're getting that kind of rate of return on our money. Versus somebody, maybe it's a mortgage and you have it at 3%, or you refinanced recently, being aggressive about that kind of loan. We're getting a 3% rate of return on our money versus we could invest that or pay off a different debt, a high interest debt, and be more efficient. So that would be the opportunity cost there.
Great. Thank you for that. Do we have any other questions out there? Sure, there's lots. People need to look at through their stuff and say, okay, what am I doing right? What could I be doing better?
Yeah, if anybody does have any questions or wants to kind of meet online, I do meet with folks on what you call it. There's no cost to meet or obligation or anything, so it's more personal. And you can ask your specific personal questions. You can shoot me an email. Oh, that number is actually wrong. 612, not 651. But that email is available. That, like I mentioned, that number is incorrect. I got to fix that. But more than happy to have a chat with anybody who wants to ask questions and see anything specific to where they're at in their current financial situation and how that relates to their future goals, whether it's practice ownership, selling a practice, whatever the case is.
Great. And if people can't write this down quick enough, you can always feel free to reach out to me and I can get you in touch with Garrett also. So I'm not seeing any other questions at this time. So Garrett, I thank you so much for your time today and for our MVMA members for attending online.
Yes.
Thank you, everybody.
Appreciate it. Everybody have a great rest of the day and stay safe and healthy.
Thank you very much. Bye-bye.
Bye.